Happy Thursday, everybody. Nice quiet day today. Not much going on. Nothing much happened yesterday. I might go back to bed, actually. Morning, Kay. How you doing, mate?
Good morning, everybody. Good morning, Ryan. Yeah, I mean, I think we should hire Stel's boat.
Yeah.
And a little round around on the Mediterranean.
Yeah, the little slippery fucker. He's jumped on a boat and gone sailing on Fed Day. God,
I think
life of it, eh?
It shouldn't be allowed, really. I mean, I'm very disappointed.
Yeah, I know. There needs to be questions asked around here.
So we need
mind you, the way the weather is at the moment, I could go boating in my garden.
Yes,
3 days.
same here. Oh, it was crazy yesterday. Yeah, it was like quite horrible.
Yeah, I know. The fish swimming past the window. It's unbelievable. Anyway, we always moan about the weather over here. Right. Oh, where should we start today? Well, as you can see from the screenshot there, just a quick look of where we are for the Fed. Obviously, we're going to delve into that in a bit more detail. We're playing the 75-50 hike game for December. The odds pretty even, 57% probability for another 75, 42 for a 50. This is probably going to change around quite a bit over the next few weeks before we get to the next FOMC. But as I said, that's where we're at the moment. That's going to be important for what we're seeing in the pricings in the here and now. So let's just crack on with some of the headlines, get those out of the way, then we'll get properly stuck into the Fed. Right, over in China, their services PMI came in a touch softer, 48.4 versus 49 expected, from a prior 49.3. So softer data on the services side from China there. Now we did get finally a denial of the zero COVID reopening rumours that we had earlier this week, with a official coming out and saying that they're going to resolutely adhere to the zero COVID policy. For those who may not have been on the show or been around, there was a couple of tweets going around that they may form a reopening committee to talk about the easing of the zero COVID policy, maybe in the first quarter of 2023. That is now officially denied. Doesn't mean it's not still going to happen. Obviously, Q1 23 is a long way away, but for now, they're keeping zero COVID policy, and they're not going to let it go. Our old mate, little fat boy, LFB, Kim Jong-un in North Korea has been firing off his toys again, shooting rockets hither and thither across Japan, quite a few more than he usually does. So that's getting a bit of warning going there. There has been talk about potentially that North Korea is supplying Russia with arms, something the US is keeping their beady eye on. It can often be a little bit of a risk move when it happens in the Asia time zone, but it's happening more regular now, so the market isn't really paying attention. Obviously, if something drops where it shouldn't, that's going to create big waves for risk. But that's what's been going on there. In Hong Kong, the HKMA raised their rates in line with the Fed. And the finance secretary said that traders betting against the Hong Kong dollar will lose. Now, as we had this discussion yesterday, I was talking to one of our viewers. The Hong Kong dollar is right up at the top of the bands. They run for dollar Hong Kong, they run a band 7.75 to 7.85, and it's been up here and sitting up here for quite some time. They will defend that tooth and nail, and as this finance secretary said, traders betting against it will lose. I'm sitting in a small short up here purely because the HKMA is the backstop there. If it does ever blow, it's likely to blow big time. I've got to stop in. I'll see what happens if it does ever go. But for the moment, I'm happy to play the top here, and no real reasons to change that. I did get out of the position a few days ago when $1 blew up, or the one weakened up to 736. It seemed a little bit spicy. Obviously, Hong Kong is now under the umbrella of China, so you never know if there's going to be changes. It's going to be the PBOC that makes the call there. But anyway, I'm still happy to play those shorts, and the warnings are coming in. The Norges surprised with a smaller than expected hike. They went 5 pips this morning, not 50. Kay, big reasons for that?
Yeah, I mean, actually, they announced that they would not do 50s all the time. So they actually went in line with what they rather said on the prior meeting. But the market, again, on the back of higher CPI data, actually was pointing or trying to price in a 50 BPs hike, and they have disappointed again. The hopium, which is the other side of the FOMC, but they have surprised on the rather dovish side. Also in the statement saying that they want to something like monitor the impact of the rises, and the policy rate has been raised markedly over a short period, and monetary policy is beginning to have a tightening effect on the economy. This may suggest a more gradual approach. So they killed a bit of hopium for higher rates faster in Norway, and the Norwegian kroner got hit pretty severely. It actually started yesterday already on the turn of the dollar. Norwegian kroner weakened faster than the euro actually did. The euro dollar actually did. So it already started a bit yesterday, but we're trading like 3% higher in dollar Norway than yesterday. So it's a pretty big move, pretty big move.
Yeah, indeed. Well, over to the UK, not much headlines out. We obviously got the BOE today, which we'll talk about shortly. There was headlines out overnight that Sunak may extend windfall taxes on energy companies, could raise, or maybe looking to raise, up to 40 billion, which will go a long way for paying for this so-called fiscal black hole of 50 billion that's floating around to do with Truss's budget and all the plans there. So that was in the news, may come to fruition or not. The ECB, dear me, the kennel was really open this morning, and we've had every direction of opinion this morning. We had Kazakh saying that rates need to go much higher, and there's no need to pause hiking at the turn of the year. 75 pips is not a benchmark. We'll need to slow at some point. Nagel came out saying need to hike further and mustn't refrain from hikes under political pressure. Obviously, some of the countries where rate hikes are biting more than others may be starting to put the political pressure on their central bankers. As we know, in Germany, it's probably the other way around. They're putting pressure on to hike more. But when you got 18 countries, or was it 19? I forget. 18 countries in the Eurozone, however many it is, everyone's got an opinion on what hikes are doing. And then we had Panetta taking a bit of the other side of the trade, saying bigger hikes may heighten volatility. Then Lagarde came out saying that a recession won't be enough to settle inflation. It's a bit of a similar line to what the Fed are doing, is that they potentially going to hike through a recession. If one comes along, inflation is the devil they need to tame, even if it's at the cost of some economic activity. Centino then came out and said a good part of hikes should already have been done. So really, they're, a broad range of opinions, you could call it. I'd call it none of them know their arse from their elbow, and a just complete mess of comments. So what do you make from that, Kate? Hawkish, dovish, what in the ECB?
Yes.
Thank you. Moving on. Now we've cleared that up.
I mean, what do you want me to say? I mean, no. The thing is, okay. If we only take Lagarde, for instance, I think she summed up a little bit what all the others were saying, barring the Uber hawks, because she will never be an Uber hawk. But she said, like, yes, we need to continue to tighten, but then have to watch for the side effects, or what was it? Clearly, she doesn't want to over tighten financial conditions. She's also mindful of the recession, I think, and it's that what is ultimately weighing again on the euro, in my opinion, is that she still, as the leader of the pack, she still is not a hawk, even though they all agree that they still need to continue to hike rates. But that's a global central bank thing now. Yeah, I think that was a little bit the kicker. And that's what who was it? Centennial also said, or some other guy also said that they have to be mindful of any knock-on effects or side effects of what the tightening means. So that puts them back behind, or what the Fed is doing, in my opinion. So that's one of the reasons why we are where we are right now in the euro.
Yep. No, indeed. But obviously the big effect today has been the Fed, and let's get straight into that now. Now, obviously, lots of comments, lots of headlines, everything. So I've just tried to keep it to the real key points. Obviously, Kay will step in if I miss something or he has something to highlight. So, long and short is we've had the Fed turn more hawkish, Powell's turn more hawkish, as you can see quite clearly from the 2-year yields on the screen. Forget that print up there. The cash market was closed last night. That's an errant print, so don't worry about that. This is the real move. We are potentially making a new rate ceiling for the Fed. So how did it start off? Well, it started off with the announcement and statement, which the market got a little bit out its pram over on the dovish side, because there was a line in there that's saying that with regards to hikes, the Fed will take into account cumulative tightening, policy lags, and economic and financial developments in determining the future pace of hikes. This was what all the pivoters and the doves jumped upon, sending the dollar lower. They insinuated that the pace of hikes will slow, which, as we know, was going to happen anyway. That should be no surprise to anyone that they were going to slow. And Powell reiterated this afterwards by saying that he had been saying for the last few meetings that they would slow at some point. And he added into that a slowing may come as soon as December or even February. He made no bones about that. He was pretty explicit about that. We knew that they're going to be slowing, but he's starting to put dates on it now when they may slow and the reasons why they may slow. But what's really important is how he delivered all this, because right after that came the big hawkish kicker, and that was that the ultimate level of rates will be higher than previously expected, and that the data suggests that we may ultimately move to higher levels than anticipated in September. So the delivery here was really important. He gave the dovish stuff first, he gave the warnings on slowing hikes, and then he followed it up with the hawkish stuff. And that is very deliberate, because it sets the tone. It gets out the bad news, then it layers over the top the good news or the hawkish news. And that's what they finish with. And it's important because if ever that formula switches the other way, where he gives the hawkish stuff first and then the dovish stuff, that's a potential change in their thinking, in the way they talk and what they're going to be doing. So it was very deliberate that he, as I say, gave the dovish, less hawkish stuff first, then gave the hawkish stuff after. But the other really important message was, and you know, you guys and girls who have been following us on the Flow Show and in the room for ages know we've been getting on about this. He said the important message was how far they go on rates. He said how far to go on rates is the important question, and that pausing is not something they are thinking about or even discussing. So that tells us everything we need to know. Okay, they're not going to stop. And it's not about whether they hike 25, 50, 75, 100s. It's where will rates go. But the real big kicker is that comment on the ultimate level of rates. He has effectively said they're going higher than they forecast previously. And I've got the dots here because this is one I wanted to highlight. Oh, no, not that one. Done that one. Come on, where are you? There. So this is the prior dot plots that we saw in the September, and we don't get the next one until December. So he says they're going higher, or the expectations may be higher than previously expected. So let me get my old drawing pen out. This is what we're talking about here. Okay, now what we don't know is where the dots are going. Are we going to? I think it's more likely that maybe we get a couple maybe up here, but I think the bigger risk is that these here step up a bit higher. Maybe not as high as 5% or above, but these now go in that sort of area. I also think the second risk is all these. That these all shift up to a similar picture to this. So next year, well, this is 2023, so they're going to go higher. But next, for 2024, these perhaps come up a bit too. Because what they are stressing is that rates are going to stay higher for longer. So we may get a move of the ceiling. Let's call it the 5% ceiling. How many go above this line will determine how strong the dollar reacts and how strong yields react. If it's just these moving up to this 5% mark, or this coming up to there, you know, as long as we're not breaching that 5% ceiling too much, then I don't see there's going to be much for the dollar to gain on that. But it could gain on all these dots moving up further out, setting a longer time frame for heights being stronger. Now, as you may remember yesterday, I wasn't expecting him to talk about the ceiling. I was expecting him to punt that to December. So that to me was a real hawkish shift and the real surprise, because he's now setting the stone or setting the stall out now for that. And so naturally we're seeing, as we're showing in the 2 yields back on the bullish side. You know, we've broken out of that 4.4, 4.5 area, sort of a midpoint for hikes, the ceiling. Now we're heading towards the 5% mark. This is going to be the driver for maybe several days, maybe a couple of weeks, until the market gets to where it wants to go and prices where it expects the ceiling to come. Now, obviously, we've got some big risk events. We could have the dollar bid all the way through till tomorrow. Then we get a really crappy NFP, and we see some of that hawkishness torpedoed quite strongly. We'll probably come all the way back down, so in 2s to 4.5%, because the market will say, hang on, he said this, but the jobs market's turning. We're not going to get that high. Or we could get another strong jobs number, and then we're going to see a secondary kick on up, because now he's been proved right. The data says he's been proved right that they may have to go higher. Now, we've got 2 CPI reports and 2 jobs reports before the next FOMC in December. So there's a lot of water to go under the bridge. Data is going to remain important for matching it against what the Fed says. So from here, as I say, I'm expecting the dollar to remain well bid, but it's going to come down to now, can we break the bigger levels? And that's always what I look at. I'm not interested really what happens in the middle here. This is just noise. If this is another real hawkish shift from the Fed, let's take euro dollar, it's these lows down here I'm going to be watching. That's the kicker. If we're going to move out of this range, those are levels that need to break. If we can't, if we get down here, test and hold, if we can't break those, even while the Fed's turning hawkish, the price can only go one other way. That's why you look at the longer levels. That's why sometimes you need to take yourself out the short-term noise, pick your wider levels going into these events, because they're the key ones that make or break any particular move or swing in sentiment or whatever. Kay, what do you make of it all last night?
Well, exactly. That's what I said straight away. When after 3 minutes, it was into his presser, it was pretty clear, and I said it straight away on the chat. I said he delivers the soft message first on the economic leading indicators, and then now we are starting to swing already again, and that's where the dollar bid came from afterwards. You've basically covered everything on the FOMC. I just wanted to highlight one thing, which was a bit surprising, and to which he actually gave in. There was this question, McKee or so, from one of the newspapers asked him about the 3-month T-bills forward in 18 months, and he showed. I'm going to show that. The chart when I'll be looking at some pictures, and it was an interesting reply actually that he said, yes, that's the one we are looking for. That's the one we are really looking at. So and that's just around the zero level or just above right now. And it seems that if that would go below zero, that may mean at least a slowing in the pace. So we are very close to it. So that's an interesting one to pick out. But yeah, globally, it was a very hawkish meeting. There's no doubt about it. He killed the pivot callers. He killed the hope for a pause. It's really we are going to be on our way for longer and higher, of course. And we always have to look at everything. As you rightfully point out, we've got big reports coming out in between now and the December meeting, so a lot can change. If tomorrow all of a sudden we get a very negative labor report, all the zombies will rise again and call for the next pivot, right? As I said in the room, I don't know how many pivots we can trade. I don't know, but yeah, one day they will be right. But I don't think it's now. So looking forward, just quickly, if we get only a mild miss on the NFP, and the headline would send the dollar a bit lower, but if wages and the unemployment rate, participation rate don't give any panic, I think there will be a lot of dollar dip bias around tomorrow.
Yeah, no, I agree. It was quite funny being in the room yesterday. Everyone was like, "Oh, look, there's the flip from dovish to hawkish." It was clear as day. Now I'm looking at. I've been shorting dollar yen. I got out some of that 146.25 in the drop down. I didn't actually trade the other way on the hawkish lines. Don't ask me why. Maybe a bit of tiredness creeping in. But I missed the opportunity to jump on the hawkish lines. I'm still interested in being short. I still have a short dollar bias, but I'm gonna be a bit more picky for now because I want to see how this plays out. I need to see how this develops. Is there a real chance of the Fed hiking to a higher ceiling, or is this just going to be talk? Because remember, a lot of it yesterday was about the Fed's rebuilding their credibility that they lost when they let inflation kick them up the arse, basically. And that was actually something that Powell touched on as well yesterday, because he went on to this thing saying that if they over tighten, if they hike too far, they have the tools to counter that. Now, some of you may remember it's a bit deja vu because he said that when they thought inflation was transitory, and they said that if ever inflation became problematic, we have the tools to deal with it. Now he's saying it the other side of the coin. He's saying that if they over tighten, they'll respond the other way. So it's a bit of a funny comment there, just to show you how two things. A, that's a hawkish comment because they're effectively prepared to over tighten if need be. So hike further than they need to go because they can always cut rates after. But two, it's just another warning about how they may get caught out not knowing where inflation is going to go, so on and so forth. So for me and my dollar bearish thoughts, I'm going to sit on my hands maybe for a bit, see how this plays out, but I'll be watching the levels. If we get a move up to these levels, you know, these big prior highs, 150s, 149s, up to that 152s, and we hold, then I'm going to have a bit more conviction to start scaling back in to those sort of trades and keep my dollar bearishness bias going on. Aussie dollar, that was another one. Didn't even really get close. Well, we had the spike to near 65s, nowhere near the prior 65, 20, 40 area. Now we're heading back down. Need to watch the levels again. Similar situation to the euro. We got a bit of a level, 62.70s. That's going to be one to keep an eye on. Otherwise, it's 62 and the prior low. So again, if we do start breaking some of these levels, I'm going to be questioning my long, obviously, and may have to reflect and close them out and see where we go next. But if we can't break these levels, then, as I mentioned, usually the price can only go one other way, and that's the opposite direction. So it's going to be very interesting the next few days to see what happens with this hawkish twist. Is it going to break the ranges, or is it going to keep us in the ranges? So if you are unsure what to do now with your trading, you don't know whether to jump in here in euro, dollar, whatever, you've seen big moves, the natural instinct is to fight them because, hey, we've already gone X amount of pips, surely we're not going to go anymore. That's the wrong attitude to take. Go to the wider time frames, look at the bigger levels, because they're the real ones that are going to make or break what we've been seeing over the last few months. And that's why I always do the exercise of looking at the higher time frames. Right, Kay, do you want to have a little review of what you're looking at,
Yeah,
what's
sure,
going on, and then we'll have a quick chat on the BOE.
Yeah, of course. Can you give me the hand? Okay, thank you. So first of all, here. First of all, this one I just mentioned. This is that thing that came out, and I missed it during the interview, but then during the press conference, but then my colleagues made me listen to it again, and it was really interesting because Powell was really saying that this is something they really look at. It's the implied yield on the 3-month T-bills in 18 months. It's kind of a forward rate. And that's the forward that they are looking at. And that's something that has been coming back to close to zero. I don't know where the people get the comparisons for the recession for, because it just dipped below smalls and then immediately rebounded. But Powell acknowledging this one, so this is something that, and I'm sure it's going to be mentioned on FinTweet a lot, is something that we should perhaps keep an eye on for possible hints at whether they will slow and to what measure. But I thought it was an interesting little fact yesterday. So then moving over to my usual pictures. Rainbow time, yeah, here we go, rainbow time. Hey, but you look at this, Mike. I've really cleaned it up, right? So this is a very, very clean picture. This is the 2-year. Yeah, this spike, I don't know where it comes from, but basically we have been trading in this upside wedge, and we are now testing the high. And then there's now I want to talk just a few words on repricing, and because I think it's the same mistake that people make when they say the Fed is, or well, mistake is a big word. I respect everybody's opinion and what the market is saying, but everybody calls those spikes and moves repricing of what's expected during the next meetings. We have to know something. Money is flowing in and out of the bond markets non-stop, right? So we always, and it's reflected on Reuters and Bloomberg, and we always hear about repricing, and now we are starting to hear we are already repricing February for perhaps to go 50 or even 75 or 50 BPs, and then December perhaps being another 75 BPs. I think repricing is much too strong of a term. It's just that people in the bond market need to hedge. Now, yesterday we had the message from Powell that we are likely to go higher and for longer. So what happens in the bond market? The guys who were speculating on a slowing of the pace or a shorter hike cycle, they have to hedge, right? So and people who are already engaged in contracts and things like that, or well, the Japanese will rather be on the 10-year, but they have to reprice the short end of the curve. So they're repricing the curve. They are not repricing necessarily Fed hikes. We can see still in December the 50 bps, and in February the 25 bps, as Powell himself hinted at the possible slowing. But in the meantime, we are seeing those swings in the bond markets. So take it with a pinch of salt when people are starting to expect December hikes at 75 and February at 50 or so. It's likely overdone, but we may not see it. How shall I say, in the dollar, in the value of the dollar, but it's going to create volatility in the bond market still. So even if we get only 50 in December and 25 in February, it could be that we are on the path for a longer term and stay higher for longer. So those people have to hedge. And I just wanted to get this one out of here, because some terminology that I'm seeing on especially FinTwit right now is really raising the hairs on my arms. On my head it's not possible anymore, but on my arms. So here we are. We are around the top end of this wedge in 2-year, and we are slowly grinding higher. So this one is going to be very, very important tomorrow. Very important tomorrow, because if we see any slowing in the job market, or really negative labor report, this is going to get a knock on the head again. If in turn the labor report stays strong, and we know it's a lagging report, but the market will react to the headlines. If in turn it's a strong report, this thing could really start to move up closer to the 5% mark, in my opinion. On the 10s, well, we've tried to correct it, and I said we're probably going to be somewhere around 4% going into the Fed, and that was exactly where we were. Now we are well back inside the channel, and again the 4% is going to be a benchmark level, adding to it the 390, as I said already a couple of times. But this should now, unless we see bad job reports, this should now hold the 4% market, perhaps going to target again the former highs. I'd say that the 10-year is probably going to be moving a bit slower than the 2 years, because we are still pricing, the market is still pricing beyond all the Fed hikes, is still pricing a slowdown of the economy. So in theory, the curve could invert even a bit more. We're already trading 50 bps, which is quite a lot. In a normal cycle, this would actually be dollar bearish, but I don't even dare to pronounce that word right here and now, because we
just
are.
On that, Kate, sorry, mate. Just on that, because it's just been reminded of one of Powell's comments last night, is that he said he wanted to see real interest rates up across the curve.
Yeah.
Which is quite a, again, it's another hawkish, another strong signal, because there's a difference between rates and real rates, or real positive rates. How do you see that affecting the curve? Is it going to give the whole of the yield complex a big lift, or are we still going to see, these little differences, like we're seeing between 10s, 20s, and 30s?
Yeah, I think the differences will remain, because those are forward-looking economic expectations. But it could invert the curve a little bit more. And I'm just, while I'm on this picture, I was just looking at oh, here we go, countries. Looking at what he exactly, because we've been discussing that in our room many times, and we see that the tips are all well into positive territory, which which we thought were the real rates, but they are talking about other real rates. So now we are like scratching our head a little bit to know whether it is the core PCE, whether it is the simple core prices, which are at 4.5, and the core PCE index is at 5.1. If they talk about this 5.1, then rates will go above 5%. But if they talk about the 4.5, which I think is probably closer to reality, so if you put the whole curve above 4.5%, that means that, for instance, on the 30s, you've got another 30 BPs to go. On the 20s, we are there. On the 10s, we got another 30 BPs to go. If they want to put the whole curve above there, then right now, today, right, then the long end should really go more or less parallel with the short end, perhaps even a little bit faster. But as I say, we are still a bit in the dark about which measure point they actually take to tell us everything should be really into the positive. Because if you see the headline PCE prices, they're at 4.2 quarter on quarter. So everything above 4.2% should be enough. But I'm a bit afraid that they are talking about 4.5%.
Yeah, and just to explain to people who may not know, when we talk about real rates, so you've got, you look at the 10-year there, you've got a rate of 4.2%. Once you've added the inflation into that, the rate might be negative. So let's say we're talking about the core rate that they use of 5%. So you're getting 4.2%, but inflation's 5.2%, for example. Then your real rate is negative 1%. So when Powell's saying about getting real rates up, he wants yields to be basically above inflation, so that if you are putting your money into bonds, you are earning more than inflation. So that's why it's important when you hear about Powell talking about real rates, what that means in terms of government bonds that you look at and the inflation rate. That's why it's important.
Yeah, and to add to that, I'm extremely surprised that none of the, unless we missed something on all the meetings and all the press conferences, I'm extremely surprised that none of those reporters asked him what is the exact rate that you use to measure the real rate. Because this is so much room for interpretation. Yeah.
We'll have to ask Timmy Leaks.
Come again?
I said we'll have to ask Timmy Leaks to go and ask him.
Yeah, or the new Fed whisperer, right? Okay, let's quickly look, because time is going on. There's one that I'm keeping a close eye on now is dollar yen, because we are getting closer and closer to where we think that the MOF or the Bank of Japan, let's call it for the easy of, or the submarines were sitting on the offer around 140, 48.80. And to be honest, I haven't seen the spike yesterday really deep below 146. But if we take into account what Kuroda was telling us, that 200-300 points moves were seen as excessive, if you take the low of the day, we are already 250 odd points higher. If you take the start of the move, we still have a bit of room, right? We were around this 146.80, 148.30. That's only 150 points. But if you take into account, if you look at the 148.80, 85, which was the high on Monday night, that's going to be above the 200 mark, whatever low or whatever starting point we look at. So pay a bit of attention if ever today we would get closer to that level, I'd say. And then quickly, a few ones here. Still, we're back in the downward channel on the euro dollar. I know Ryan is looking at the longer term, so I on purpose look a little bit shorter to give a bit of a different view. This was the one I was looking at. We are trading below it right now. Now, I think, and I'm going to stick my neck out here a little bit, I think we may be close to a pause now in the move. We've had our FOMC move. And now we should really start to prepare for what's going to happen on the labor report tomorrow. So in my humble opinion, and I will say very humble opinion, for the day, I wouldn't be surprised to see a pause starting to build here, perhaps correct a little bit. And I don't think we can go very high. If we see somewhere a 98 print, I already think that there's going to be enough supply to stop the rebound. But again, I wouldn't be surprised to see a bit of a pause right here and now, a bit like in line with what's happening on the dollar yen. Cable, we're having a pre-Bailey sell-off in the cable here, and I'm not too sure why sterling should be hit more than the euro, for instance, ahead of the Bank of England. I know that when Bailey talks, usually the sterling takes a hammering, but I'm not really sure why this is. There's no fundamental reason really to send sterling lower than euro comparatively. Anyway, a bit of a support here that we tagged around 112 and a quarter, 112.30. That's going to be the first level I'm watching into the Bank of England. Any rebound up to 113.40.50 worth keeping an eye on. Above there, every 25-30 points, we will have a little bit of resistance. If we start to break below 112 and a quarter, though, then we're looking at this zone here around 111, 111 and a half, in my opinion. This one interesting, euro sterling. We've again bounced off this 85.70. I thought it would be the 86.50.55 would hold today, but we had a retest here of the channel high, and that's coming in around 86.75.80. So that's a good marker, I think, for a starter into the Bank of England. 86.5 may be a bit close, but then you look at the low 86s. So 86.10, 86.80, worth keeping an eye on in the euro sterling. If we go above there, bid at 87, but then I think the more interesting zone is going to be once more the 87.25.40 level on the euro sterling if we get above, and that'll depend on the message that we get from the Bank of England and then Mr. Bailey. If in turn we get a surprise hawkish Bailey and we start to collapse through 85.70, then we can go have a visit and into the low 85s. And I think, well, people in the ForexAnalytix crew at least are keeping an eye on this low 85. I think Ryan as well, you're keeping an eye on this low 85 in the euro sterling?
Yeah, definitely, mate. Yeah.
Yeah, okay. So yes, this is going to be the next important level. But first of all, respect this 85.70 as well, if it would come down. I'm just going to show a couple more, and then I'm going to pass it over to Ryan for the Bank of England. Dollar China. We had those little spikes lower on the start of the FOMC meeting. I took advantage of them to reload a bit, trading them in and out. I had actually two nice occasions to sell some out, buy some back, sell some again. I'm still bullish. Dollar China 726 is the first intermediate zone here, and that should hold. PBOC also still injecting, albeit lesser amounts today, but bringing the fixing up. So I still think longs are relatively protected by what's happening at the PBOC. Of course, if you're in the game, make sure to protect it with stop losses. Okay, if you start to go below 720 in the short term, that could be a bit of a sign that this needs to take a breather. And with the fixings where they are above 720 now, this is really a nice area to lean against. Dollar MEX, is a strange one. It tried to go below here yesterday. This is the weekly, yeah, from the 2017. This red line around 1960s, 60, 62, depending on the thickness, was a bit of a level we traded below, but we are not yet trading below the prior lows. But I think what happened yesterday, rather than dollar mix, is euro mix again, and now the euro mix is breaking under the prior October low that we put in. So and we have to look at the longer term. I think there's a bit going on here in the low 19s, but well, you know my position, so I'm talking my book. If I don't do it, who else will? I think we may be on our way to mid-18s, unless all of a sudden Lagarde goes much more hawkish, or we're seeing a double whammy for the mix, which would be much weaker US data combined with the Bank of Mexico starting to slow or stop hiking rates. They are up next week, if I'm correct, and they are expected to raise another 75 BPs up to 10%. So the interest rate differentials are still very much in favor of this position. And with that, I give it back to you, Ryan.
Yeah, no problem, mate. Anna Wu just asked a question. I'm late for the show. Tut tut. That'll be detention for you. How can I listen to the full show today? It's not available to YouTube. I don't know if that's because Stell's away, but if you want to catch the show, it will get, it is recorded and it will be released later on today. Keep an eye on the ForexAnalytix Twitter stream, because that's where it usually gets put out when the show is released. Right, so the Bank of England, is that one frying pan into the fire? It's an important one today because it is accompanied by the monetary policy report, aka a press conference. So we will be hearing from Bailey. It won't just be a statement drop. We'll get the super nuts, questions, everything like that. Now, we all share pretty similar thoughts in the room, and OK does too. It really is a bit of a coin toss. They could do 50s, they could do 75s. There's even a small chance they could do 100s. I think the probability is, the large probability is that they go to 75. I would put that probably around a 60% chance. Going a 50, probably around a 30% chance. Going a 100, around about a 10% chance. And the reason for that is we had all this mess, obviously, back in September with the mini budget and yields blown out, so on and so forth. That was putting us in the 75 to 100 mark. That fear has obviously calmed down now. So on that basis, it probably puts us 50, 75. But then you've got to remember we're still running inflation over 10%, which keeps 100 on the table. Now, we know that Bailey and co have been in conversation with Sunak and Hunt over what these fiscal plans are. That was going to be a big input into their decision today. So if they go a big hike, maybe even 100, then perhaps they've had a bit of insight knowledge that there's going to be some extra borrowing to come and that hikes are going to be needed to keep all that sort of stuff contained. If they go a 50, that would suggest the opposite, that what's going to come is more on the austerity side, so no need for increased borrowing that much, and then no need for yields to start blowing out again and the market throwing a tizzy like it did last time. But I should think 75s is what's going to happen, but I really think it could be anything. And as Kay mentioned, Bailey has a habit of delivering something hawkish and then turning 180 and being completely dovish in the press conferences. Trading it, I think what Kay said was right. I think if you get a decent rally in cable, that's going to be the easy trade to take. The dollar is the king. We know what's happening now because of the Fed. I don't expect the dollar to weaken significantly anytime soon, albeit short term up until the NFP as the next risk event. So if you get a pop in cable, if we get anything up high 113s, 114s, I'm going to be eyeing that for a short, just for a reaction, because the dollar's going to take over at some point. Whether we get that or not, I don't know. It's going to be the path of most resistance, selling the dollar versus the pound. But you never know what happens. You might get a spike up, and if that's the case, that's going to be one area I'm going to be looking at. As for euro sterling, yeah, Kate pretty much covered it. I don't have much more to add. I'm looking to get long lower down. I'm only interested in selling this if we go really much higher, but I want to know the driver for that. So that's for the Bank of England. If you do have any specific questions on the BOE, throw them up in the chat room now. I'm not overly, I haven't got a huge interest in it, put it that way, from the trading point of view. It should pass by pretty without much fuss. What I would say is keep an eye on the vote numbers. They're going to be very important. It's a bit different to how some of the other central banks run. So there's 9 people on the MPC. They will all vote to hike, or leave unchanged, or to cut. And then within the statement, we'll get whether they were looking for bigger than expected hikes, or some were looking for lower than expected hikes, so on and so forth. As long as it's 9-0 in terms of a hike, so everyone's in favour of a hike, that's fine. If we start to see some changes, maybe for unchanged, maybe for cuts, that's when things turn a little bit dovish. That's how you get your signal from the Bank of England. So that's what I'm looking at there. One of the last things I wanted to look at is gold. I'm keeping my beady eye on this one because we're down at that fib level. Really strong in this 16, 15, 17 area. This is the fib I've been watching for a long while. I know others have got an area from different fibs off different areas, but this is the one I've been watching for a while. I may dip into a little long here, testing the level with a reverse, because like I said, with Euro, Aussie, all the others, these are the big levels you want to watch. If something's going to change, they're either going to break or they're going to hold. And if they break, this will be a third attempt, then that's maybe a break to run with. It's good, maybe give your legs down to at least 1600. Conversely, a level's a level until it's not. So if you want to try longs, and that's maybe what I'm going to go with in a moment, keep it tight, keep it fairly small. If the level can't be broken, there's only one way it can go. So that's that for today. Oh, it's only Thursday, mate. Still got a day and a half to go. I'm going to need a long weekend and a few beers this weekend. Austin, Hawkish BOE, can we look at Guppy?
Can I, while you're changing charts, can I just reply to Mike, because he had a question, and then he already messaged us saying, then thank you for not answering my question. And I remind you, this is a free show, yeah? Just wanted to say it in between. Our Fed funds are already above 5% for March 2023. Is it close to be priced in by the bond market? Yes, I mean, it's a bit in line with what I said on the hedging and on the forward-looking pricing of what may happen. But they may be above 5%, but it doesn't mean for that reason that there's going to be a big change there, because if the Fed is driving rates up to 5% or above, it's still going to be a very high level compared to where other blocks may end up, right? And I'm thinking about the Eurozone or Switzerland or the Bank of Japan. So yeah, I mean, it can be priced in, but it's not because rates pause that they necessarily have to come down, right? So there's a bit there's room for interpretation on what is priced in and what should happen then. I hope that answers your question.
Yeah, thanks, mate. As far as Guppy goes, as I mentioned, they're not one I really have a lot of interest in. I just watch it, you know, more just as what wind is blowing which way. Now, obviously, this is lower, coming down more on the pound side rather than the yen side, because obviously we're seeing the dollar strengthening So that's lifting dollar yen. So we're not seeing this move in tandem with the yen moves. So it's mainly moving on the opposite of what's happening in the dollar, hence why it's lower. I know some of you guys have been shorting up near the top, and well done on those trades. Keep it going. Into support, again, it's going to come down to the stretch situation. You know, how much further can the dollar go before we get a pause? You know, Kay highlighted the level where it might go in euro dollar, might get into a bit of overstretched territory. Doesn't mean you're going to bounce 300 pips. It just means enough's enough for the moment. So this is pretty similar. Look down to sort of the 166, down to these prior lows as well. Call it 165s. That's the sort of area, if you're short and looking for places of support, potential stretch points, those are the sort of areas you want to be looking at. If we get under those, obviously we're not done. So just know which way the wind is blowing at the moment. Trying to pick bottoms is going to be a bit of a dangerous game for a few sessions in pairs like this. Feel free to do it if you've got something to lean against, manage your risk against, but just know which way you're playing the crowd, and that you can adjust your trade sizes and risk management to suit, because if you're fighting it, you want to go less and tighter. If you're going with it, you can give yourself a bit more room, bigger and wider on your stops, so on and so forth. And you watch us on 1.5 speed on YouTube. Okay, I'll have to check that out. Just to let you know, the joining webinar signal on the FA homepage didn't display to join. Yeah, thanks, Rick. I don't know what's going on. It's to do with this clock change. Steve apparently fixed it yesterday or the day before, but fixed it by 2 hours instead of 1 hour. I don't know if he's changed it back again. I don't know what it's done. If they're not on the beach in America, sailing around islands on boats, we might get them to fix some of this stuff. But hopefully by next week it'll all be sorted. If not sooner. Righto, Bank of England next. See you tomorrow. NFP. Thanks, Kay. Have a good day, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.